You're watching CRE Radio and TV. Today, we're going to discuss who will benefit from a rise in interest rates with Dr. Sam Chandan. We'll be right back. At Allen Madkins, when it comes to real estate, we help clients capitalize on opportunity. AMP Technologies, the Uber manager for your commercial real estate. It will simplify your asset management. Who's going to benefit the most from an increase in interest?
Well, I think there are going to be, many participants in the market, perhaps not all of them commercial real estate investors, that will benefit, from an increase in interest rates. I think when we look at, who has really struggled in this environment, outside of the immediate commercial real estate environment, we've got pension funds, certainly, that have had to generate returns in a way that allows them to meet their pension obligations. We've had retirees that are on fixed incomes where, the optimal portfolio is a relatively conservative one. And I think both of those segments of the market have struggled mightily in an environment where it's been very, very difficult in a risk-averse portfolio allocation to actually generate meaningful returns. And so I think that has been problematic. I think that, if you are a lender in the market, if you're an investor in the commercial real estate market, the implications of higher rates are perhaps more ambiguous. Where I think in the long term it does benefit all of us is that we cannot think of rates in the market today as being privately determined. They are rates that reflect, again, unusual distortions, significant interventions in the market, a significant degree of risk aversion in the global environment. We have significant capital inflows into the safe haven of U.S. assets, even where those assets return, in some cases, negative real returns. That scenario, that situation won't persist forever. But what it has allowed for is an inflation of asset prices. And for an example of where I worry about this is that we have individual investors in the market who may describe sort of a borrower's market because capital is so freely available. When they borrow, it's very cheap. But what they may be ignoring in that scenario is that for all of the same reasons why they're able to borrow cheaply, everyone else is able to borrow cheaply. That is increasing the levered yields on any kind of investment that you might make, and that is pushing asset prices higher. And so even though you may be able to borrow cheaply, you're also having to pay a significant premium for the asset relative to the income it generates to acquire it in the first place. And that, again, presents a problem. Ultimately, as rates begin to rise, what that should allow for is a more modest pace of appreciation in the market. It means some of the opportunistic investment capital in the market ultimately rotates out and finds other places to invest. We find ourselves in a market where there's potentially fewer of those investors who are benefiting from the way in which low-cost capital can accelerate that pace of appreciation, but then the underlying driver of improvements in asset values is ultimately returns to and becomes more concretely anchored in the underlying fundamentals of the properties. And again, in the long term, I think we're better off. We have a more sustainable pace of improvement if the rate at which values are increasing is tightly aligned to what we see happening with underlying property fundamentals. And that's not a place where we've been the last couple of years.
At Allen Madkins, when it comes to real estate, we help clients capitalize on opportunity. AMP Technologies, the Uber manager for your commercial real estate. It will simplify your asset management.